During your working years, a bad investment is a setback. But as you near or enter retirement, a bad investment can be catastrophic. Today we're talking about a popular product many investment advisors are selling to their retired clients, but one that has hidden risks lurking within it, and one that some people say is being deceptively marketed: structured notes. Welcome back to the channel. I'm Zach Palmer, certified financial planner at Ark Royal Wealth Management. Wouldn't we all love to find an investment that lets us participate in the gains of the stock market, but with none of the downside? Of course we would. But as the saying goes, if it sounds too good to be true, it probably is. And in the case of structured notes, it's the fine print that too often goes unread that we're diving into today. If you've been pitched a structured note, it was likely sold under the guise of principal protection or a downside buffer or some other attractive lingo, all promising the same holy grail: capturing the market upside with none of the risk. These products are being called boomer candy, and as we unwrap them, you'll see why this candy can be bad for your financial health. First, a quick explanation of what a structured note is. These products are a complex mix of a bond and a stock market option. Their objective sounds logical: trying to grow your money but also preserve your capital. One radio pitch we've heard sounds irresistible. You'll get the S&P 500 exposure with 100% protection and a 9% potential gain. But as research shows, that's not safety, and that's a sales trick. Here's the simple formula for one of these can't lose strategies. Roughly 95% of your investment goes into treasury bills, essentially cash, and 5% goes into a narrow S&P 500 call spread. That's it. You could build this yourself in a few clicks. One aspect of the protection that many consumers find attractive is that most notes don't offer full downside protection. For example, this note only offers protection of a 35% decline for the worst performing index, leaving the investor exposed to enormous loss in the event of a significant decline. A far more common danger exploiting an investor's fear of loss is the silent and invisible killer: loss of purchasing power. The return of your principal is not the same as the return on your principal. If inflation is high, receiving your full par value years later or a 0% return means you've still lost significant buying power. This is why 100% protection is often just a fancy way of saying guaranteed loss after inflation. At Ark Royal, we construct retirement plans to mitigate sequence of return risk without the expense or limitations of boomer candy products like structured notes or indexed annuities. If you'd like to schedule a complimentary consultation, click on Book a Call with Zach in the show notes below. This is where structured notes become even more of a wealth drain, especially in retirement where every dollar matters. These products are simply basic building blocks repackaged, and you pay an outrageous price for the fancy wrapper. We've seen notes with an upfront commission that equates to a stunning 11% upfront fee. That's $11,000 on a $100,000 investment gone on day one. These aren't investor-friendly fees. They're the old Wall Street playbook dressed in new language. Many structured notes are tied to multiple indices: the Dow Jones, S&P 500, and Russell 2000. Sounds diversified, right? Well, this is actually a diversification mirage. We've seen many structured notes that appear to be diversified, as they show 2 to 3 indices. But here's the tricky part: your payout is often linked to the worst performing index. That means your return depends on the index which performs the worst. That's not diversification, that's a booby trap. In our investment portfolios, which we view as truly diversified, you get the returns of all the different asset classes: large cap, small cap, international, emerging markets, REITs, and bonds. That's how true diversification works. For retirees, there are three main things about structured notes that make them hazardous to your retirement success. Number one, opportunity cost and performance drag. You need growth to combat inflation over a 30-year retirement. Structured notes limit your upside. One study found that since 1990, these protected strategies have historically delivered only about 4.1% per year versus 10.5% for the S&P 500. That 6.4 percentage point drag translates into hundreds of thousands of dollars lost over your retirement. In reality, you traded one risk for another, reducing the risk of temporary principal decline for the erosion of purchasing power. Number two, illiquidity is a nightmare. Liquidity is essential in retirement. What happens if an emergency happens? There is a very limited secondary market for structured notes, and buyers in this market demand a significant discount for providing you liquidity. Think of it as if you were selling your note at a fire sale price, only there's no fire. Number three, counterparty risk. If you own an ETF, your money is held separately and safely. It's hard to imagine a scenario where all 500 companies in the S&P 500 go belly up. A structured note is a debt obligation of one financial institution. Think it can't happen? Well, ask holders of Lehman Brothers structured notes, who ultimately received pennies on the dollar. If your issuing bank fails, you're simply a creditor standing in line. There is no FDIC or SPIC insurance. In retirement, do you want your financial security depending on one single bank? These products exploit what psychologists call loss aversion, the fear of short-term losses. The industry knows retirees hate seeing red on their statements, so they use manipulative marketing terms like downside buffer and defined outcomes that promise comfort and control at the cost of your long-term return. It's emotional manipulation disguised as financial innovation. The winning strategy is simple: low-cost diversified funds designed for steady growth. Stock ETFs for growth, bond ETFs for stability. It's built around your goals, time horizon, and risk tolerance, and designed to weather any market environment. If an advisor pitches you a structured note, especially when you are nearing or in retirement, it's a massive red flag. And what you should do is ask them these three questions. Number one, what is the true effective fee on this investment? Demand a number higher than the small basis point fees. Number two, what is the opportunity cost? Show me the difference between this product and a low-cost diversified fund or portfolio over the last 10 years. And three, if I need my money in 1 year, how fast can I get it? And what will the fees be? The answer should be instantly, with no fees and no haircut. If any of these answers are vague or complicated, you know what to do. Walk away. Your retirement is too important to pay premium prices for basic exposure and capped returns. If you have questions about what's in your retirement portfolio, we'd be happy to offer a transparent, no-nonsense review. Leave a comment if you've had an experience with these products. And don't forget to like and subscribe to the channel for more guidance on securing a better financial future. I'll see you the next time.
If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.